Very pleased to welcome back to the show Lance Roberts is with me. You can find him at www.realinvestmentadvice.com. Lance, first of all, appreciate you finding time for us.
Absolutely. Always happy to do it for you.
Well, what a great week, eh? I mean, lots of stuff to talk about. I mean, I'm still, as many investors are, we're reeling from that Wednesday action when it didn't matter where you looked. Asia, obviously led by the Dow Jones, down 370 points, but currencies moved, everything moved. Do you think it was a significant day? I mean, what I'm saying is that are you worried about follow through? Did that sort of tell us that the significant market correction's underway?
No, so a couple of things that are important about Wednesday. First of all, there's been this overriding belief that you should just put your money in the market and just, buy ETFs and passive index because, you just can't time the market. Well, what Wednesday shows you is that when you have everybody crowding into one trade, so remember back in the 90s, we were all getting into tech stocks. In 2007, it was all about real estate. And now everybody's piling into ETFs. We're having massive inflows into ETFs. And while I've written this several times is that while passive indexing is fine while the markets are rising, it's important to remember that when things happen, those passive indexers become active sellers. And we saw that on Wednesday. We just saw dumping across the board, irrespective of who it was. And even the big tech leaders, Facebook, Amazon, Netflix, Google, were the big losers on the day. So it just goes to show you these very crowded trades are also extremely dangerous. And while we were fortunate that Wednesday was quickly recovered over the next couple of days because of more fake news coming out of the New York Times, the real point here is that we do have a crack in the armor. We were unable to get above 2,400 on the S&P 500 after multiple attempts. We failed. We broke support. And if we don't hold this current recovery into next week, we could see lower lows going into the summer.
Well, one of the things that, of course, is come out is that, Mr. Trump is, far more pro-business president than previous President Obama. He's talked about the massive drop in taxes, especially the giving that repatriation incentive for companies to bring, $2.5 trillion back that are held overseas. You've got the decrease in regulation. We've got the infrastructure trade, all of that stuff. Are you worried that's now been derailed? And if it has been delayed, let's say, and let's talk significant delay, do you think that the market has a significant reaction to that if it comes to that conclusion, let's say?
Sure. Well, first of all, can we backtrack just 1 second here? Yes, Donald Trump is pro-business, and that's absolutely true. He's got the right ideas. But let's also remember something. When Ronald Reagan cut taxes and did major tax reform, it was after two back-to-back recessions, and we were just coming out of those recessions. Valuations in the markets were 7 times earning. Dividend yields were at 6. When President Bush cut taxes, that was right after the 2000 drop in the market and recession. Here we are. We're now talking about cutting taxes and doing tax reforms after 8 years of a bull market. We've already had a lot of economic recovery in terms of length and time of economic recovery. And so it's important to remember that getting tax reform and things are great. And I'm definitely not opposed to it because I'm a businessman, so it's good for me. It's also important about the timing. So in other words, the bang for your buck that you get out of doing tax reform here may be substantially smaller than what we've seen previously because valuations are very high. We've got a long-term economic recovery already in place, and you're already starting to see some weakness in the overall structure of the economy. So to your question specifically, has this been delayed? Yes. We have likely been delayed. I talked to 3 senators over the last week, 2 congressmen on my radio show here in Houston, and every one of them has said that maybe we'll try to get something done this year, particularly it'll be in 2018. The big fight's coming up in September when they actually have to try to pass a budget.
Yeah, it is interesting, of course, as we all know, that the market discounts things in the past. You're not betting on the horse race when it's over. So you're right. I mean, so much of this stuff is factored in, but I love your point about where we are on the economic cycle, that the recovery's already begun in there. So how much more juice do you get out of this? But does that tell you then maybe you back away from the markets a little bit? Because even if, as they, sort of the expression is they've priced for perfection. Easy for me to say, obviously, Lance. Perfection.
Yes, I think that's exactly right. I think you do have to consider the fact that we have priced in for perfection. If you take a look, when Donald Trump first announced tax cuts, immediately everybody ran out and they said, okay, so if we cut taxes from 35 to 15, that's going to throw $1 onto every quarter's worth of earnings. That means by 2018, we're going to be at $130 worth of earnings. Well, by the time we get through revising and doing all this, we're now pushing $130 of earnings out to 2018, and yet the market is higher than it was when we initially priced in 130 to begin with in terms of earnings growth. So it is very important that the markets have already priced in a lot of what you may get. And here's the other side of this. Everybody's pricing in the fact that, to your point earlier, we're going to bring back $2 trillion from overseas. We're not. We're going to bring back maybe $200 billion to possibly $500 billion. Remember that most of that money that's stored overseas is for overseas operations. Mm-hmm. Companies are now globally interconnected, so they're not going to just bring all that money back all of a sudden. They need it overseas for acquisitions and other things that are going on with those companies, Apple, etc. But so we may get $200 to $500 billion coming back from repatriation, but
I think I'm describing heaven. Kick back, listen to Money Talks, and get a little Beach Boys in your ear. Also, we've got Lance Roberts with his Clarity Financial coming with us out of Texas, but where you can find him is www.realinvestmentadvice.com, including their free newsletter, which I think is it's great reading, especially when you're talking about the kind of things that are going on and buffeting the markets. Lance, just before the break, we lost you a little bit when you were talking about, and I thought it was another great point, the repatriation of the capital that's being held overseas. It's obviously a good idea to try and get it back in the country, but as you point out, not a lot of it is sort of up for grabs because they use it for overseas operations.
That's right. And so we may get it back in the States, but, it's mostly going to go to share buybacks because simply, revenue growth remains exceptionally weak, and the way that people are controlling the issue of creating earnings growth at the end of the year has been through financial engineering like share buybacks, cost-cutting, wage suppression, etc.
Okay, so let's take it the full circle and come back to individual investors here. I mean, it is an incredibly difficult environment when, the latest tweet can change the markets, or the reaction, or an overblown story. I don't know if you saw that. You haven't seen it. You got to have a look at that Harvard study on the kind of coverage the main media outlets, both TV and newspapers, are giving Mr. Trump. I think it certainly justifies a lot of his complaints there, but still, those kind of overblown stories. Like today's big one was that he called James Comey a nut job. Well, I was thinking, can you imagine what Comey's called President Trump behind his back? But these things kind of have an impact on the market. And so what are you sort of telling individuals to do, how to kind of get through this period?
Well, the thing is that we have to be aware that when you're managing money, that your own money in particular, that set all these other things aside, these are moments in time where we have so much infiltration into the markets, and everybody's so closely watching every little single tweet, every earnings announcement, and you take a look at the volatility movements in individual stocks. A company comes out and they report better than expected earnings. They're up 5, 6, 7% in a single day. This shows you, or vice versa, they come out and they miss earnings by a penny or two, maybe have a little bit of weaker guidance, and we drop market caps by, $1, $2, $3 billion in a day. That just goes to show you that we have moved into a position in time within the markets that fundamentals at this structure of the market mean very little, because so much money has piled into, and we were talking about this earlier, into ETFs and into these passive indexes, into these algorithmic structures of where just momentary movements in the market make very big price changes because of the flow of money into and out of particular issues. And remember that when everybody dumps an ETF or everybody buys an ETF, as an example, all the stocks that make up that ETF have to also be bought. So this is why with people, everybody piling into things like the XLK to participate in the run in tech stocks, that immediately goes to boost the shares and prices of things like Facebook, Amazon, and Google, because those are the biggest market cap shares in those indexes. So we're getting a lot of distortions in the market, and that tells you two things. One, suppressed volatility is a very big issue now because there's absolutely no fear of a correction of size or magnitude in the market. And the second thing is that when the flow of money starts to leave assets due to some issue, whether it's a realization we're not going to get tax reform anytime soon, or a geopolitical crisis, or whatever it is, the gap that opens up below prices can be very significant and leave investors kind of left with shock and awe, so to speak, when it occurs. Kind of like we saw on Wednesday, something you completely don't count on moves the market very big. And if you're not prepared for that and don't have something in place, have a little extra cash, some type of buffer, it could potentially hurt you, particularly going into the summer months, which tend to be weak anyway.
Yeah, that's the other thing. The seasonality certainly points to a slowdown in the market. You know, the old sell in May and go away and come back after Labor Day, or whatever variation on that theme we've got. Yeah, right. So that's also playing a point. One of the things I thought was interesting, though, in all the news this week, is I was watching the drop in the percentage of big money that thinks that there's going to be a June rate hike in the United States, because that also has an influence up here in Canada. If they hike their rates, I think that's a negative for the Canadian dollar, because we're not going to hike our rates at this point. So what are you seeing that in terms of the Fed? Have we got enough uncertainty that maybe they even back off in June?
The odds of a rate hike have declined for the month of June, by the way. So that's a very good point. I think that the Feds are going to probably, at this point, barring any other thing that comes out between now and next month, I think there's still a pretty good probability that they will hike rates in June. They've been floating messages across the market over the last couple of weeks, talking about June rate hikes, talking about, hey, we're going to be here if anything happens. And the markets have responded positively. Remember, if in between Fed meetings, we trot out all these Fed speakers, right, Bullard and all these guys, they come out and they drop messages in the market. You'll have one Fed guy come out and he'll say, well, we may not hike rates anymore, and they watch how the market reacts. Then another one will come out and say, okay, we're going to hike rates 4 more times this year. They watch how the market reacts. That's how they're gauging the market to see whether or not they can raise rates. It's all about communication. Right now, it looks like they'll raise rates in June. I think they're making a huge mistake, and it's ultimately going to impact the economy very negatively because of all the economic structures in the economy tied to rates. But they realize we are closer to the next recession and they've got to get off of zero so they have something to use to combat the next recession when it comes. So they've got to hike rates, and I think they know that.
Yeah, I think it's a great point. That it's sort of counterintuitive for people that they're worried about getting into a recession, but you're so right. I mean, what happens when they do? Well, if they've already got rates at zero, they can't, of course you can get negative now, I guess we found out in Europe, but, it's not as easy, let's just say. So, yeah, it's nice to bump them up a little bit so they can at least be seen to be taking action if we get that slowdown. And, yeah, I mean, we've never had the robust recovery that would normally come out of the depths of what started to happen in 2008.
Right. No, you're absolutely right. I found it very interesting. You were giving the quotes about Obama versus Trump, and one thing to remember, as senator, he was the one that was chastising Bush for basically doubling the national debt during his previous tenure. And then, of course, he said, that was unpatriotic, and he does it over the next 8 years, doubles the national debt again. With one thing that nobody's talking about, and I just talked to the Committee for a Responsible Budget 2 weeks ago. We're looking at currently, with tax reforms and tax restructuring, adding another $5 trillion to $6 trillion worth of debt to the federal debt over the course of the next 4 years to 5 years. If that occurs, again, that slows economic growth. The reason we can't generate higher rates of growth in the economy is because of debt, not only national federal debt, but consumer debt, student loan debt, auto debt. And by the way, watch auto debt, because subprime auto loans and even prime loans are now starting to hit delinquency rates that were not seen since the prior financial crisis. So the debt issue is the one thing nobody's paying attention to, but it's the biggest driver of economic growth, or actually lack thereof, over time.
I couldn't agree more. That is going to be right front and center coming up. And we haven't done anything to change the structural challenges. That student debt loan problem in the States is scary. Lance, thank you so much for finding time once again for us in the weekend. As always, great stuff.
Hey, I appreciate it. Thank you so much.
You can find more with Lance. Go to realinvestmentadvice.com, realinvestmentadvice.com. He has got his blog there, always great reading. It's absolutely free for you. Take advantage of that.